slides
Okay,
can be seen on
we can see the slides now.
Okay, perfect. Approximately we have 13, 15 slides. So during approximately 40 minutes, I'm trying to cover all those slides in details. But as we think that we have approximately 15 slides and 40 minutes, in each slide, we are trying to allocate approximately 3 minutes. Then I know these are really technical issues. Some of them really necessitate some introduction and prerequisite about the financial and economics, financial market and economics principles. But I know you may not be understand some of the topics and some of the points here. You can ask all your questions simultaneously here in chat side by writing all your questions detailedly. Then if you don't have a chance to do so, at the end of the session, in 10 minutes, I will complete all the slides. Then I will allocate 10 minutes for a brainstorming session for all participants to make them easy and possible to ask their question. So at the end of the session, for the 10 minutes, we will make a brainstorming and you can ask your question about the topics and a global market out together. Let me start Fed and ECB tapering process in monetary policy today. Here, as you see in the slides, we have global inflation pressure. So what we mean by global inflation pressure and what we are trying to cover here today topics, because we will try to cover and go into details of the monetary policy of the European Central Bank and Federal Reserve, and what is the basic principle, why we are trying to make it the tapering operation. The tapering operation is coming from because we have huge inflationary pressure around the global market. Okay, the inflation is rising up, so the central banks should take some measures about this issue and to decrease the inflation rate. So what are the ways of decreasing the inflation? All central banks have brilliant staff and making operation, but even you are not a brilliant staff, during 500 years, the basic principle between the interest rate and inflation is clear and understandable. The principle is this: if the market is heating up, meaning that if inflation is going up, the basic principle in economics is you should increase the interest rate according to the Taylor rule. Taylor rule is one of the best well-known monetary policy rule all around the world, which is used by the central banks as well. This rule saying that if the economy heats, meaning that it is warming and the inflation is going up, you should increase your interest rate. Then, after the increase in the interest rate, the consumption, investment, and aggregate demand will decrease. When the demand decreases in basic principle, the inflation and prices will decrease as well. This is the basic principle. So why, if you ask me, why the central banks need a global tapering process, the basic reason is we have inflationary pressures all around the world. So here we see the graphs and the charts of the core inflation, and as you see here the time period from the 2013, 2003 until the 2023, approximately 20 years horizon. And here the percentages change of the inflation all around the world. And these are the basic economies in this graph. The black is US, purple is Eurozone, and the light blue is the United Kingdom. What we mean by core inflation? Core inflation is this. While we are calculating the inflation rate in an economics, we are trying to make and build up a basket here. We mean by approximately, let's say in UK, maybe 1,000 or 500, or in United States, in UK, it is approximately 300. In Turkey, it is approximately 350 goods and services in the basket. And while calculating the inflation, we included all these items in the basket. And let's say this month, the price of this basket is 100. And let's say next month, when we calculate the basket prices, it is 101, let's say. So I am calculating inflation this month, the prices is 100 and second month is 101. So percentage in change is just 1% monthly. So what is the core inflation? Core inflation is in the basket, we have all type of goods and services. Okay, in the inflation calculation, we have lots of different goods and services and products and items. But if I want to focus on the core inflation, I should exclude the items which prices are volatile, like the fresh food, like the energy prices. Okay, these prices are really volatile, especially in the seasonality effect. For instance, in the summertime, fresh food, because of the supply increase, fruits, products, vegetables, is really high production in the summertime. Its prices is decreasing. But in the winter time, because there is no production in vegetable and fruit market, the price is really increasing. So to see the real effect, the real trend in the inflation cycle, I want to exclude those fresh food, energy prices, utilities from the basket. And I want to focus on what is my main prices, main consumption in the basket. This is the core inflation. So if we look at the graph, as you see here, during approximately 20 years, not 20 years, but 18 years, the inflation is around just 2%. And why the 2% is important for us? The 2% is the inflation targets of the central banks. And central banks are really successful to put the inflation in the band of the central bank's target during the 18 years. But what happened here? Here, a bird in China distributed its sicknesses to all the people around the world, the COVID crisis. And suddenly, market is collapsed. All the restaurants, all the shoppings, all the buildings closed. And nobody is consuming. Nobody is perception. And look at it here. Please look at this part. When the COVID starts, inflation first go down. Okay, this is the important point. Inflation is going down when the COVID starts. Why? Because nobody is consuming. Nobody is investing. There is no demand in the market. If there is no demand, prices will go down. Inflation will decrease, right? But the decrease in the inflation too much is not also good for the central banks because it is decreasing the economic growth. So what should the central banks do? They should do to increase the inflation. But sometimes you cannot adjust those shocks. For instance, when you started to buy some of the asset-backed securities and market-backed securities from the market, and you are starting a quantitative easing period in the economy, then people will have an access to cheaper money, right? There is no interest rate. It is just in the zero lower bound, no interest rate condition. You can consume everything. You can buy everything because there is no cost. Then the prices started to increase. But what happened here? What happened here? It is not just because of the people increasing their demand. The cost inflation also comes here in the fore. What we mean by cost inflation? We have two types of inflation: demand and supply inflation. Demand inflation is when the people consume, when the people invest, when the people demand. It is a demand side inflation. But if the prices increase because of the supply condition, like the Russian-Ukraine, like the supply chain brokerage in the market, then we will face the cost side of the inflation. Even you don't buy anything, because of the cost rising, prices is going. So here, when we reach here, this is mainly because of the quantitative easing of the central bank. But after this period is here because of the supply chain brokerage in the market. For instance, normally a vessel from the Shanghai to California reach, let's say, in 1 month to these harbor. But because of the COVID process, because of the supply chain brokerage, there is no production in the market, there is no demand in the market, those type of things. The delivery of the ships extended to 2-3 months. Supply chain. And because there is no available products in the market, there is no ships bringing the products from China or India, the prices is going up. Then, accordingly, at the same time almost, the Russia invade the Ukraine and the energy prices, commodity prices, wheat prices, corn prices is rising sharp. Then, after here, until here, we have demand side inflation. But from here to here, we have supply side inflation, cost side inflation. For that reason, you should differentiate what we mean by demand side inflation and supply side inflation. And when the inflation rate reach approximately 7% in these economies, these are the best and developed market in the world. They are really good production, they are really good GDP per capita, everything is good almost in these countries. So even in these countries, US, Eurozone, and United Kingdom, when the inflation rate reached 7%, now the central banks take another measures, which is called, as we go into details today, is the global tapering period in monetary policy. What we mean by tapering? We will increase the interest rate to fight with the inflation. As you see here, after the increase in the interest rate accordingly, the demand, consumption, investment all started to decrease accordingly. Slowly, gradually, but it has started to decrease. For that reason, the inflation, the year-over-year inflation started to decrease as well. And how we can adjust our monetary policy stance in the market? We are making regular survey in the monetary policy market with the inflation expectation. And when you look at the inflation expectation for the United States, Eurozone, and UK, as you see here, the UK, almost the inflation expectation is approximately 4% at the end of 2023. And it is approximately 2.5 for the US, and it is approximately 1.9 for the Eurozone region. So what do we mean by here? Please look at it here. This is the current inflation in this region, approximately 5-6%. And what is this? These are the inflation for the 5 years later, expectation. So if you manage the inflation expectation successfully, then this means by your monetary operation in the market to decrease the inflation is successful. So the central banks in this developed market achieve this type of target. Answer. The answer for the inflation expectation is successful. Please look at the slide first for the 20 seconds to try to understand what we try to cover here to understand the basic principle in the monetary policy operation. What we mean by here, the global monetary policy, market expectation for the central bank policy, and global central bank balance sheet. On the left-hand side, we have market expectation for central bank policy rates. And these are, now we are at another developed market economy. This is the Japan. The black is United States again. Purple is the Eurozone. Light blue is the UK, and the green is the Japan. And these are, please look at the explanation here, market expectation for the central bank policy rate. So what the market expect for the central bank in these developed market economies for the next couple of months. And as you see today, for the UK and the United States, the policy rate for the central bank is around 5.5. But it will decrease accordingly after 1, 2, or 3 years. it will decrease accordingly to 3%. But for instance, for the Eurozone, it is now 4%. But it will gradually decrease to here. Why? Because the inflation expectation, as you see here, decreasing. So no need to put the interest rate so much high. What is the disadvantage of putting interest rate here? There will be no production. Nobody will borrow. Nobody will go to the mortgage market to buy the house. Nobody will buy the car. Nobody make investment if the interest rate is here. Okay, so the central banks should put the interest rate with the market expectation of the inflation rate and to trigger the production and consumption in the economy as well. And what is reversing? The most important point is here is this: Japan. What is reversing? Japan is increasing their interest rate. Why? Because it is not included here. But if you see the Japanese inflation, for instance, the UK inflation, US inflation, or the Eurozone inflation is around 5%, but Japanese inflation is just 1%, even less than. So there is no inflation in the Japan. So no need to then decrease the interest rate to increase the inflation because inflation is sufficiently low. So they should increase the interest rate after a long time. And here what we have, this is a global central bank balance sheet, and the unit is in the United States dollar in trillions. Please look at this. Here, a small sharp increase from 4 trillion to 6 trillion dollars, just 2 trillion central bank balance sheet expansion in the global financial crisis of 2008. But what happened here? From approximately 15 trillion to 27 trillion, $12 trillion increase in the balance sheet of the central bank. What happened here? As we call quantitative easing period. Okay, quantitative easing meaning that I am buying asset-backed securities from my balance sheet, and I am giving the United States dollar to the market with cheaper prices, zero cost, at the zero lower bound interest rate. Okay, I am buying those assets, and these increase my balance sheet, and I'm giving the money. But what is happening here? Now, because the inflation is really rising up, now I'm increasing the interest rate. I'm giving your asset-backed securities to your balance sheet, and I'm taking my money, the United States dollar or euro, to my central bank. So because I am selling now the securities, my balance sheet is shrinking from 27, and now it is around 20. But until reach the pre-COVID period, I should continue my tightening of the monetary policy until my balance sheet decreased the $15 trillion. Now we speak about the global monetary policy, but monetary policy and the fiscal policy is a complementary part for each other. So when we speak about those operations about the monetary policy and fiscal policy, they are complementary. So if you are fighting with inflation, and if you are just tightening the monetary policy, but increasing and expanding the fiscal policy, your inflation targeting will not be successful. So fiscal policy and monetary policy should be compatible to each other while fighting the inflation or while triggering the economy. So today, lots of countries around the world have the contractionary, tightening monetary policy. And global fiscal policy should be compatible. It should be also contractionary fiscal policy, fight with the inflation. And here, as you see, public sector investment. So if the public sector increasing their investment, it is an expansionary fiscal policy. So here, as you see, the public sector after the COVID crisis, like we have quantitative easing and expansionary policy, and the fiscal policy is also expansionary. But after the tapering period, public policy, public sector investment also should be contractionary to fight with the inflation. So while you are cutting the money in the market, But if the government spending the money, you cannot stop the inflation in the market. In one side, you are cutting, but in one side, you are injecting liquidity. So this will not be compatible and logical operation in the monetary policy and fiscal policy side. Public sector budget balance. Why this is important for us? This is really important issue because while making the global macro indicators, we are speaking about the budget deficit, like the inflation, like the current account deficit. We also speaking about the budget deficit in the market and budget deficit, budget balance. Why it is important? Because when the government increase their budget deficit, this means that their expenditure is really higher than their income, meaning that government expanding so much rather than collecting the tax. And what happened here? Even the United States government sent 2,500 cash check to all households who is in case of need, right? Direct cash check to their household and consumer, because during the COVID process, they don't have income to make them alive in the life. So they send direct subsidy. So if you are sending 2,500 for each household in the case of need, this will be a huge spending for the government, and your budget will be in a huge deficit during this period, approximately 15% of nominal GDP. But the normal period is just around 2%, right? Then how you should finance this type of operation? Then after the COVID, you will increase your tax rate and the budget deficit will converge its long-term period average around 2 or 3% compared to the nominal GDP as percentages. When we look at the global government debt, why this budget deficit and government debt is important, we have in fiscal policy two indicators, especially the Maastricht criteria in the European Union. They have some criteria for the European Union countries, for the 30 countries in the EU. They are saying that budget balance, the budget deficit, cannot be higher than 3% of the GDP. And they are saying that government debt cannot be higher than 60% of GDP in the European Union as well. So 60% is compatible GDP level. And here, as you see, almost all the countries is higher than 100% today, meaning that their government debt is higher than their GDP. This is huge. For instance, in Turkey, the government debt is approximately 28% of the GDP, because if the government debt is huge, this can be made your country as a fragile to external shocks, right? Because you have huge debt. If you cannot find enough money to borrow your debt, it will be a huge depreciation in your currency, current account balance deficit, budget deficit. Those type of external shocks and sudden shocks can come into fore in the economic indicators. For that reason, what happened here, government debt, it is also increasing because of the COVID period. But after the tapering period, we are here. What is the problem for the United States economy? Because of maybe the election period here, I'm thinking about that. Their government debt is really huge, approximately 130% of their GDP. But for the Eurozone and UK, it is even around 100%, and for the Eurozone, it is less than the 100% as well. And as the government debt increasing, government interest payment is really huge as well as the nominal GDP, meaning that each year you are paying 3% of interest for your whole economy's interest payment, public debt. And this is a huge money, extremely huge money. When we look at the global consumer balance sheet here, on the left-hand side, we have countries. Please look at the countries here. I will not go into details of all those. The US, Germany, UK, Sweden, Spain, France, and Italy. And you see the color in the graph. You can differentiate those countries according to those colors in the graphs as well. But on the right-hand side, on the left-hand side, you see the nominal house prices. Please look at it here. Until here, the house price between 2008 and 2014 stable, even decreasing. But especially after the COVID starts, the house price is rising up because of the cheaper money in the market, quantitative easing period. And the increase in house prices will trigger the inflation as well. And here on the right-hand side, what we see, household debt, the consumer, household, basic people, not the financial sector, not the institutional firm, basic people like you and me. These are the household sector debts. And as you see here, after the global financial crisis, household debt, because of the increase in the interest rate, decreasing gradually until the COVID period started. When the COVID started, with the cheaper interest rate, household debt started to increase again because lots of people borrowing from them. Because interest rate is really low. Central bank decrease interest rate to zero lower bound. And during this period, as you see, when the interest rate is cheaper here, the household debt is really rising. But after the interest rate increase with the COVID response, the tapering period, during the tapering period, after the increase in the interest rate, we see that household debt as of the nominal GDP will really shrink and decreasing their 10 years or 15 years average. Because interest rate is really high, cost of money is really high, household debt started to decrease the gradually. And here, when we look at the overall economic indicator, economic monitor of the United States, on the left-hand side, we have the broad indicators like the Conference Board leading economic indexes and the credit indexes. As you see, the 15 years, look at here, the blue, the light blue showing 6 months prior. And the purple is showing the latest, the current condition there. And the economy index is almost the same. But for the, look at it here, leading credit index. For the credit market, today, I am really, really better than when we compare to previous 6 months. Or for the consumer and services, consumer confidence. 6 months ago, consumer confidence is here, but now consumer confidence is decreasing in the United States. But when they look at the ISM non-manufacturing index, these leading that normally we have purchasing manager index and PMI indicator in the ISM manufacturing. But if we speak about the non-manufacturing index, the latest is here, but 6 months ago we are here. So the manufacturing, non-manufacturing indexes in production is increasing as well. For the manufacturing side, it is the same as well. The manufacturing 6 months ago around just 10, but now it's around 20. And the labor market, when we compare to non-farm payroll, okay, the 6 months ago, the non-farm payroll, who people applying for a new job is here, but latest condition is here, meaning that my employment market is really good and non-farm payroll application is really decreasing as well in the United States. So all indicator almost showing and signaling a better recovery after the COVID process in the United States, thanks to the tapering period. And here we have Federal Reserve policy rate expectation. So this is, please look at the time horizon here. Please look at this chart first because you should understand the details of the charts here. In this chart, we are trying to cover the approximately from 1970 till now, meaning that's 60 years. 60 years horizon. And these gray dashed line are the recession period in the United States economy. Okay, here we have petroleum prices, Iranian crisis, Gulf crisis, dot-com crisis, global financial crisis, and COVID crisis. Okay, These are the recessions in the economy. And now, in each recession, please look at the interest rate going down. In each recession, interest rate going down. In each recession, interest rate is going down. After the recession, because of the quantitative easing, interest rate is going up. And now the policy rate expectation will be decreasing in the long run projection, and it will be around just 2%. Please look at it here. It will be around 2.5% or 2% in the long run for the Federal Reserve. And during this period, how the United States decreased their inflation? Please look at the threshold values of the United States headline inflation. The dark blue is private sheltering. The light blue is restaurant, hotels, and transport, meaning services sector. The green one is food at home. The purple one is autos. The black is energy. The green is other items, and the orange is total. So when we look at 1 year ago and today, the inflation is around 9% in the United States 1 year ago, but it is just around 3.5%. Overall, it's approximately decreased 50%. But what is important more, it is composition is also changing. For instance, energy is a really high contribution here, approximately 3% for the overall inflation because of the Russian invasion of the Ukraine and the supply chain. But now energy is minus. There is no contribution of the energy to the overall inflation. Or when we speak about the other items is almost zero. And when we speak about the auto, please look at chips and automobile contribution. There is no contribution from the autos as well. But what is still continuing in a huge pressure, this is private shelter and the services sector. This is really still high. And the United States, while making their federal open market committee operation and decreasing the interest rate, or speaking about the rate cut operation, they want to say that this private sheltering and restaurant, hotels, and transport inflation should also substantially decrease in the market to persuade the Federal Reserve governors decrease the interest rate. So they are still patient and will wait until the mid-June to rate cut operation in the financial markets. And here, as you see, we have US goods and services inflation. Services, as you see here, the black line, and this purple one is non-food and non-energy goods. So here, as you see, goods inflation is almost zero. So today, we are only speaking about the services inflation in the United States. Goods inflation is nothing. It is evaporated. Normally, goods are really high, 12% 1 year ago, but today it is melting. But what is happening? Still sticky price in the housing and services sector inflation in the United States. So when we skip the United States and when we turn the page for the Eurozone economy, so as you see, the financial condition index in the Eurozone, the latest condition is really good. But 6 months ago, Euro is shrinking. It is approximately 40 in the Bloomberg Financial Condition Index and 70 today. And then for the consumer confidence, unfortunately, 6 months ago and today is almost same. So consumer cannot build up their confidence in Eurozone economies. And unfortunately, the worst case is business expectation. 6 months ago, business expectation is better than today in the Eurozone. Why? Because Eurozone is a production economy. And when the interest rate is going up, there will be no production in the economy as well. The ordering will be postponed for a near future. We don't know how much, how many minutes, how many days, how many months or years all over the orders in the business market will be postponed because they know that if the interest rate is high, nobody will buy something, nobody will consume something. So business condition is shrinking in the Eurozone economies as well. And when we look at the manufacturing production, it is almost same. So there is a really stable but recessionary signature of the manufacturing PMI in the Eurozone. And the labor market, even better unemployment. Labor market is better and unemployment is decreasing. So 6 months ago, unemployment is here, but today the current unemployment is decreasing. So they are achieving the employment market. They are almost good in the financial sector, but the production side for the Eurozone economies is not. And when we look at the same picture here, remember this picture for the United States, now we are trying to see the threshold values and the brackets for the Eurozone headline inflation. As you see, the energy is the highest contribution during the July 2022 because of the invasion of the Russia. Okay, invasion of Russia of the Ukraine is bringing the highest contribution of the energy to the overall inflation. But now, energy contribution is nothing. And also, as you see here, the main partner here is coming from food, alcohol, and tobacco. As you see, normally they are really small brackets here, but here their contribution is really high. And the sticky contribution is coming from the core services with the light blue. They are almost increasing every day and never decreasing. As you see, the food, alcohol is volatile. It is increasing and it is decreasing as well. Or the core goods increasing and here decreasing as well. But the core services is not never decrease here during this period and almost stable. So today in United States or Eurozone, we are speaking mainly about the services inflation, not the goods or foods inflation. As you see, core inflation and headline inflation is here. And core inflation is here, but the headline inflation is here, meaning that headline is less than the core inflation. Why core inflation is sticky? Because there is services inflation in the Eurozone region for the overall inflation level. And until they decrease the inflation rate to their targeted level of 2%, they will never cut the interest rate. Even their business sector, as you see here, the business sector and manufacturing PMI decreasing. Because to increase the production in the economy, if they cut the interest rate, this inflation will never go to converge to the 2% of the ECB targeted level. And we look at here the central bank policy expectation for the Federal Reserve, but we will take a look at the same picture for the European Central Bank policy rate expectation. You will see here, after the tapering period, we will increase the huge rate hike in the policy rate of the European Central Bank until the 4%. But in the second half of the 2024, the European Central Bank will start to cut the interest rate. Here you see the tapering period. This is tapering period, but this will be the normalization period for the European Central Bank. And this blue gray dash line are still recessionary period for the Eurozone economies. And why this graph is really important? If you want to see the risk and something wrong in the Eurozone, you should look at the country's 10-year treasury spread with Germany. Why we are looking at this? Germany is non-risk country. And if your spread between Germany and your country increasing, meaning that your risk is increasing. As you see here, when the debt crisis, Eurozone crisis coming from the Greeks, Spain and Ireland, the spread is rising up. As you see here, during the COVID period, the spread is going up. In normal period, if there is normality in the Eurozone economy, the spread between the Germany and France, Spain, or Italy should be lower. If the spread is opening, this meaning that the risky outlook coming in the Eurozone economies. And the last slide from my side here today, the Eurozone focuses economic surprises and the recovery fund. And there's a really good chart on the Steward of Economic Surprise Index here. The United States is black and the Eurozone is purple. And the economic indicators coming in above the expectation here, as you see, the Eurozone is not good in this sense, because especially in last 2-3 months, the Eurozone economic indicators is worse than the expectation. But as you see here, the United States is above the threshold. So in economic indicators shock and positive outlook, United States is really differentiated from the Eurozone. In employment market, in financial condition, in inflation targeting, everything is really better. Even in the unemployment rate or the non-farm payroll. And as you see here, this is the showing the overall packages, actual forecast disbursement and initial plan disbursement. This is the Eurozone, European Union Recovery Fund transfer in the Euro billion. And this is showing how they need this type of extraordinary funds in case of need to save the government production, to pay the government debt. And as you see here, there's a huge increase and the forecasted period as well in this purple actual forecasted disbursement. There is a really need of the EU fund to save some economies and to pay the public debts, especially because of the after COVID period and increase in the inflation.